Hello, and welcome back to the channel. I'm Algabot, and this is where we take apart automated trading strategies for MetaTrader 5 and study exactly how they think. Today we're examining an expert advisor called Sequential Record Imbalance. It's an unusual one because it doesn't rely on a moving average, a classic oscillator, or a familiar chart pattern. Instead, it's built on a branch of probability theory called record statistics. By the end of this video, you'll understand how it measures market drift, how it decides to go long or short, and how it manages risk once a position is open. Let's get into it. Let's start with the big picture. Sequential record imbalance is a drift detector. In plain terms, drift is the tendency of a market to lean persistently in one direction over a stretch of bars, rather than wandering aimlessly. This expert advisor tries to measure that lean using record statistics, which is the mathematics of running highs and lows. Here's the core idea. Inside a rolling window of bars, the strategy looks for what it calls records. A bar is an upper record when its high is greater than every earlier high in that window. A bar is a lower record when its low is below every earlier low. There's a classical result in probability which says that for a market with no real direction, upper and lower records tend to appear in balanced numbers. Only genuine drift breaks that balance. Persistent upward movement renews highs far more often than lows, and persistent downward movement does the opposite. So the strategy counts the upper records and the lower records, takes the difference, and turns that imbalance into a single score. It then compares that score against its own recent history, standardizing it into a Z-score, so the system calibrates itself to each instrument and each market condition automatically. There's no manual tuning per symbol. The approach is symmetric, meaning it treats long and short opportunities exactly the same way. It trades a single time frame, holds one position at a time, and manages every trade with a dynamic stop-loss and take-profit based on the average true range indicator. In terms of who this style suits, it's aimed at traders who are curious about systematic, statistics-driven models rather than discretionary chart reading. As always, this is educational information only, and trading carries real risk, including the risk of loss. Now let's walk through the logic step by step. The first rule the strategy follows is patience. It only acts on fully completed bars. Every time a new bar opens, it takes the bar that just closed and adds its high, low, and close to a rolling history. Because it never reads a bar that's still forming, its signals don't repaint or change after the fact. Once it has enough history, it measures the record imbalance. It scans the last window bars, which defaults to 40, from oldest to newest, keeping a running maximum and a running minimum. Every time a bar sets a new high for the window, that's one upper record. Every time a bar sets a new low, that's one lower record. It subtracts the lower record count from the upper record count and divides by the square root of the window size. That gives a compact score the code calls S, a level-free, volatility-free estimate of how strongly the market is drifting and in which direction. A single score in isolation doesn't mean much, so the strategy standardizes it. It takes the last score loopback scores, which defaults to 60, calculates their average and spread, and converts the current score into a Z-score. This Z-score tells the strategy how unusual the current drift is compared with the instrument's own recent behavior. This self-adapting step is what lets one set of parameters work across different symbols and market conditions. From here the rules are clean. The strategy signals along when the Z-score climbs to or above the EntryZ threshold. The raw score is positive, and the bar that just closed finished higher than it opened. It signals a short in the mirror image. When the Z-score falls to or below the negative EntryZ threshold, the score is negative, and the bar closed lower. For exits, the strategy watches for the drift to fade. An open long is closed once the Z-score slips back down to the ExitZ level, and an open short is closed once the Z-score recovers back up to the negative ExitZ level. On top of that, every position is protected by a stop-loss and a take-profit set at multiples of the average true range, and once prices move far enough in favor, the stop is pulled to the entry price to remove the initial risk. Remember, stops can still be subject to slippage, and losses are a normal part of trading. Let's look at the actual MQL5 code running inside MetaEditor. At the top, we have the input parameters. Windows sets how many bars go into the record count, defaulting to 40. Score loopback. At 60, is how many past scores feed the Z-score. EntryZ, at 1.2, is the Z-score level needed to open a trade, and ExitZ, at 0.3, is where a trade is closed as drift fades. ATR period drives the average true range, while SlATR multiple and TpAR multiple set the stop and target as multiples of that range. Break-even ATR controls when the stop is moved to entry, and lots is the fixed trade size. Now the two signal blocks. The long block reads, if Z is greater than or equal to EntryZ, and the score S is positive, and the bar closed up, then the strategy acts. It reads the current ask price, sets the stop loss 1.8 ATR below it, sets the take profit 2.8 ATR above it, and calls trade.buy with those levels. The short block is the exact mirror. If Z is less than or equal to negative EntryZ, and the score is negative, and the bar closed down, it reads the bid price, places the stop 1.8 ATR above, the target 2.8 ATR below, and calls trade.sell. Notice both sides use the identical distances, just flipped in direction. That symmetry is deliberate, and it keeps the long and short behavior perfectly balanced. Because the stop and target are tied to the average true range rather than fixed pip counts, they widen when the market is volatile and tighten when it's calm, so the risk stays proportional to current conditions. Let's bring it all together on a chart. Across the top you can see the price candles. Below them is a subpanel that plots the strategy's own signal, the standardized record imbalance Z-score. The green dashed line marks the long entry level at positive 1.2, the red dashed line marks the short entry level at negative 1.2, and the two gray lines near the middle mark the exit levels at plus and minus 0.3. Watch how the panel moves as each candle closes. We begin on the left with a market that starts drifting higher. The first few candles each close above the one before, and importantly, several of them poke to fresh highs for the window. Every fresh high is a new upper record, while the lows stay quiet and produce almost no lower records. Because upper records are piling up and lower records are not, the imbalance score turns positive, and you can see the Z-score in the panel begin to climb from the middle toward that green line. By the fourth candle, the drift has become statistically strong. The Z-score pushes up through the green long entry level at 1.2. The raw score is clearly positive, and this bar is closed higher than it opened. All three conditions line up, and the strategy places its long. That's the buy entry marker you see on the chart. At that moment, the stop loss is set below at 1.8 times the average true range, and the take profit is set above at 2.8 times that range, which gives a reward to risk of roughly 1.5 to 1. Now watch what happens next. The updrift continues. The following candles keep renewing highs, price advances steadily, and it reaches the take profit target marked above the entry. The long trade is booked at its take profit in this illustration. Notice the strategy didn't need to guess a top. It simply rode the drift while the records kept confirming it. After that peak, the character of the market changes. Price stalls and begins to roll over. Now the lows start doing the work. Each of the next candles undercuts the previous low and sets a fresh lower record, while the highs go quiet. The imbalance flips. Lower records now outnumber upper records. The score swings negative, and in the panel the Z-score falls back through the middle, past the gray exit lines, and heads toward the red line. By around the 10th candle, the downward drift is strong enough to matter. The Z-score drops through the red short entry level at negative 1.2. The score is negative, and this bar is closed lower than it opened. The mirror image conditions are satisfied, and the strategy opens a short. That's the sell entry marker. Just as before, the stop loss sits above at 1.8 ATR, and the take profit sits below at 2.8 ATR, keeping the same balanced risk profile. From there, the decline extends. The next candles keep printing fresh lows, the downdrift persists, and price slides into the take profit target below the sell entry. The short is booked at its take profit in this example. So in one clean sequence, you've seen the whole idea. A buildup of upper records lifted the Z-score into long territory and produced a buy that rode the updrift to target. Then a buildup of lower records pushed the Z-score into short territory and produced a sell that rode the downdrift to target. The panel is the engine, and the candles simply show the drift it's measuring. And of course, in live markets, not every signal reaches its target, which is exactly why the ATR stop and the break-even move are there. And that brings us to the end of our breakdown of the Sequential Record Imbalance Expert Advisor. We covered how it counts upper and lower price records inside a rolling window, how it turns that imbalance into a self-adapting Z-score, how it opens long and short trades when the drift becomes statistically strong, and how it manages every position with ATR-based stops, targets, and a break-even move. Remember, everything in this video is educational information only. It is not financial advice, not a recommendation, and not a solicitation to trade. Every strategy carries risk, and losses are a normal part of trading. If you found this analysis useful, please like the video, subscribe for more MetaTrader 5 strategy breakdowns, and leave a comment telling me which expert advisor you'd like me to examine next. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.